All right, Matt and Hayden, thanks for sitting down with me for our March episode of Plan, Protect, Invest, a Scroy Lawley podcast. Since we're in March now, we're coming up on April 15th, tax day. So I know today we got a lot on the agenda going over some things we can do to hopefully make filing your 2025 tax return a little bit easier, as well as looking at some things we could possibly do retroactively for 2025, even though we're currently in 2026, as well as looking at some things we can be more proactive about this year, particularly with the tax efficiency of your investment accounts and of your portfolio. That way, moving forward, we'll have a better tax outcome in future years to come.
So Matt, tax season can be a little bit overwhelming for some in terms of what they're expecting, maybe what they're not expecting. So can you just give us a nice overview about what people should be expecting, especially from investments that they may have with us, and maybe what they're not expecting that they should be looking out for?
Yeah, tax season can definitely be very overwhelming. But there's some things that, we can do, you can do yourself, look out for yourself to make things a little bit easier, for you when it comes to filing your taxes. Biggest thing is going to be basically gathering all of your tax documents. Now, all tax documents that are going to be generated and sent to you should all be done by around February 15th. At the latest, they should either have been mailed to you or at least be available electronically. Maybe if you log in online for certain accounts that you might have, you can gather a lot of nowadays you get a lot of those electronically too. But that's going to be basically the day that they will be ready at the latest, if not sooner. And some common tax documents to look out for would big one being W-2. Come from your employer's payroll department. It basically shows you how much you made for the year, as well as if you made any 401k or retirement plan contributions. It'll have all of that in there as well for you, as well as what you had withheld from your pay for state and federal taxes as well. Very important if you work a job and are an employee and you get a W-2. There are some other tax documents that you should be aware of, depending on other types of income that you may have. For instance, if you have any interest income, whether it be maybe like a high yield savings account you earn interest in, or an investment account where the investments that you hold in that account are paying interest, then you'll get what's called a 1099 INT, shows you how much interest income you've had for the year. Similar vein, if you have any investment accounts or single stocks or mutual funds or any other investments that pay dividends, you'll get a 1099 DIV. Shows you all of the dividend income that you've had for the year for your investments on there. Now, even though a lot of times, especially when it comes to the investment accounts, even though you have maybe your interest in dividends reinvesting in the underlying investments that you own, even if that's what you have going on, which most of the time it typically is, you still have to pay taxes on the interest and on the dividends, even if you're having that reinvested for you. Basically, you pay taxes on it in the year that it's earned. And then basically what it does is it adds to what's called your basis in the account moving forward. And basis just means tax-free. So, pay tax on it in the year that it's earned, but moving forward, if you ever, liquidated those investments, you'd pay less in capital gains taxes on that. Some other common tax documents that you might get might be something called a 1099-R. You'd get one of these if you took a distribution out of a 401k or out of a 403b or deferred comp plan, or if you took money out of an IRA or a Roth IRA, you'll get something that's called a 1099-R. And this could be if you're just taking money out of those accounts, maybe live on for the year. But you would also get one of these too if you did any sort of rollover. You would get one if you rolled money maybe out of your 401k and into an IRA. You would get a 1099-R for that as well. And it's going to have a special code in there basically saying, hey, you did a rollover. It's not taxable, but we just have to basically, report it on this form. Also, too, with the 1099-R, that also reports any pension or annuity income that you have. So if you have an annuity, maybe took a distribution for it or are receiving income from the annuity, that's going to be reported on the 1099-R as well. Or if you have, state for federal pension or private pension, that's also going to be reported on the 1099-R as well. So, covers quite a large umbrella as far as different sources of incomes and different types of accounts. So that's a pretty common one, especially for retirees or anyone who did a rollover through the year. Now, you might also get a SSA 1099. That is issued if you have any Social Security income, whether that be Social Security retirement benefits or Social Security disability benefits. You would get that. It shows how much you made for the year, and if you did have any federal tax withholding on that, it'll all be reported on that form as well. And then a couple kind of more minor ones, but definitely do come up. 1099-Q is used if you have taken any money out of a 529 plan or an ESA. So if maybe you have a kid in college and you have a 529 or an ESA for them that you took money out of, that is going to generate a 1099-Q that you basically will have to justify that money coming out, saying, okay, yeah, we took the money out of this plan, but we have, X amount in, qualified, tuition and education related expenses that you can justify that for, that we don't have to pay any taxes or penalties on that.
So that's obviously a long list of stuff to expect in form wise, but there are going to be some things that the individual is going to have to do on their own. So can you walk us through some of the top line items for those?
Yeah, there's going to be, quite a few things that you might be responsible for yourself, kind of tracking that there isn't going to be an actual form generated for you that kind of has things easily spelled out. One of these would be if you did make any traditional IRA or Roth IRA contributions. Now, if you make contributions to a Roth IRA, doesn't affect your taxes whatsoever. But if you made a traditional IRA contribution, you can potentially deduct that contribution that you made. And that's something that there's not really going to be a form generated for you to show that. There is a form generated for it, but it comes out in May. So it's not something that you can, use, proactively, unfortunately. That's a little more retroactive, but basically you would just know if you did make a deductible IRA contribution and put that on your taxes. Also, if you have mortgage interest, you will get a tax document for this. A 1098 is what it's called. If you did pay any mortgage interest, you'll get that, as well as if you paid any tuition related expenses to a university or college, you'll get a 1098 is what it's called for that as well. But when it comes to the mortgage interest in particular, that's going to be useful if someone is itemizing their tax return. Now, I do think this year we'll see definitely an uptick in people itemizing their tax returns because of the one big beautiful bill that was passed last year. We can basically, if you have your salt tax is going to, used to be a $10,000 cap. Now for most people, it's going to be a $40,000 cap. So because of that, I do think more people are going to be itemizing this year. And one of the things you can possibly take an itemized deduction for is that mortgage interest. Now there is a form that is generated for that for you, but there are some things in that same vein that there isn't a form generated for. Biggest thing being like medical expenses. You could potentially take medical expenses as an itemized deduction, assuming it's over 7.5% of your adjusted gross income for the year. You can take that as a deduction. So you'll have to track your medical expenses for the year if they are substantial enough to potentially get a deduction for it. And also in that same vein, if you paid any taxes, state and local taxes. This can be like your state income taxes that you've had withheld from your pay that should be on your W-2. Or if you made estimated New York State tax payments, those would count as well. Plus all your property taxes as well. So there's not really gonna be an official form that's generated for this. You're gonna just have to have your statement that you got from your local municipality saying how much you paid in local, town, village, school tax. All of that you could potentially get as an itemized deduction as well, that there isn't like an official form that you get come tax time for. And in that same vein, if you are making charitable contributions, if you are donating to charity, that is something that you'll have to kind of track yourself and make sure that you got all the ducks in a row with that, saying what you gave to, how much it was. That's something that you typically aren't going to get a tax form from most of the time as well, and that you can get and use as an itemized deduction potentially.
So Matt, thank you for going over all those tax forms, what you can expect, what not to expect. But why don't you tell us about a little bit more of a niche rule when contributing to IRAs and retroactive?
Yeah, so a lot of times when it comes to tax planning, you have to be proactive with it, but there are some things that we can sort of do retroactively in early 2026 for tax year 2025. One of these things is making a retroactive contribution to either a Roth IRA or to a traditional IRA. So last year, 2025, you could put up to $7,000 into a traditional IRA or into a Roth IRA if you were younger than 50. If you were 50 or older, by the end of the year, you could put up to $8,000 into either of those two accounts, assuming you qualified based on your income limits, as well as if you have earned income for the year. So assuming you qualified for it, that's how much you can put in. Now, a lot of people think that we have until January 1st to December 31st, basically the calendar year, to contribute for 2025. And right, that makes sense. But what's nice, and usually the IRS isn't so generous, but they actually let us take up until April 15th, April 15th of 2026 to make those contributions. So they are quite generous with that. So we do have basically 3.5 months where if you did want to make some contributions for 2025, we can still do so even though we're already in 2026. And you can also do the same thing with your SEP IRA as well. So if you are self-employed and you have a SEP IRA, you can also make those retroactive contributions to your SEP IRA, and you have until April 15th as well to make those contributions for 2025. Again, even though we are currently in 2026. And again, that's the SEP IRA contribution in 2025 is limited to either $70,000 or 25% of essentially your income that you get from the business, because it's going to be self-employment. Typically, if you have a SEP IRA, you're probably not going to have employees, but if you did, it'd be 25% of then the employee's salary or what they're making that the employer would have to contribute to the SEP. So we do have, again, until April 15th to make those contributions, as well as if you do have a health savings account, same thing. You have until April 15th to make retroactive HSA contributions for 2025 as well.
Okay, so we just went over you can do retroactive contributions to Roth, traditional SEP. So that period from January 1st to April 15th, you could do either the prior year or this year. But speaking on a more proactive tone, tell us a little bit about, things we should be doing before instead of after.
You really do have to be proactive with your tax planning because, if we do finish the year and our options are limited as far as what we can actually do when it comes to tax planning once we actually finish the year. So it is something that we should be proactive about. And although we want to have a smooth tax filing season for 2025 tax year, we obviously do want to make things a little more efficient than moving forward, not only for 2026, but then future years to come as well. And really where we can get a lot of tax efficiency throughout the year is with your investment accounts. Now, this is when I say investment accounts, I don't mean any sort of retirement account. This is specifically talking about non-retirement investment accounts. So any investments you have outside of your 401k or your 403b or your traditional IRA or your Roth IRA, any accounts outside of that, we would typically call brokerage accounts or after-tax accounts or investments. That is what we are specifically talking about here. Because in those accounts, even if you do have like your dividends, interest, reinvesting, you would still have to pay taxes on the earnings that you make in the year, even again, if it's reinvesting. And we have some ability to have some tax efficiency with the investments in these types of accounts. And really to kind of dive deep into it, we have to understand the difference when it comes to actually selling an investment. Whether it's what's considered a short-term capital gain or a long-term capital gain, because there's a huge difference, between those two. So let's say, for instance, you have, you bought shares of Amazon for $20,000, hypothetically. And let's say that grew to $25,000. So you have a $5,000 currently what's considered an unrealized capital gain because you didn't sell those shares yet. There's a $5,000 unrealized capital gain. Now, if you were to sell all your shares of Amazon and get $25,000 of proceeds, then it would be what's considered a realized capital gain of $5,000. Now, depending on how long you held those shares of Amazon for, that's basically going to determine if it's a short-term capital gain or a long-term capital gain. So if I bought those shares of Amazon and I held them for less than a year and a day, basically I am going to have what's called a short-term capital gain, which basically means that $5,000 of capital gain income, that's going to be taxed as what's called ordinary income. It's basically going to be taxed at the rate that all my other sources of taxable income are taxed at. But again, the IRS usually isn't generous, but in this case they are. They are generous with what's called a long-term capital gain, where there's actually a special tax rate, tax brackets that applies to any sort of long-term capital gain income that you have. So instead of selling those shares for less than a year and a day, if I sold them and I held them for longer than a year and a day, then that $5,000 gain would be considered a long-term capital gain, and it would be taxed at a much lower federal rate than if I sold it for a short-term capital gain. And not only looking at short-term, long-term capital gains, can we add some tax efficiency in those after-tax accounts or brokerage accounts, but also the type of investment that we own in those accounts matters as well from a tax standpoint, particularly right if it's a mutual fund or an exchange-traded fund. So Matt, why don't you walk us through kind of the difference with those?
Everybody's familiar with stocks and you buy a share of a company, and that company may spit off some dividends and may not. But mutual funds and ETFs work a little bit different. So think of it as a pool of money that is set out to work towards a particular strategy that has been chosen by a portfolio manager or other powers that be at these investment companies. And they say, okay, we're going to take this pool of money. We're going to pursue this particular strategy of investing with that pool of money. And essentially what you do is you rip off shares at the bottom and you pass them out to the investor. So the investor that puts their money into this pool is going to get X number of shares back because they are valued not the same way that a stock is valued, but they do have a daily value, what we call the NAV or the net asset value, that is usually calculated at the end of every day. So you have these shares that are worth something. They're going up, they're going down based off of what that pool of assets that are held by that particular mutual fund or ETF it has. So there is one huge distinction with mutual funds and ETFs because by and large, they're very, very similar investments. They, pool of money, particular strategy, you have shares. They work very, very similarly in that vein. However, a mutual fund is by and large going to be called actively managed, and an ETF or exchange traded fund is going to be by and large passively managed. And essentially what that means is on the active management side for mutual funds, you have a guy or gal that's essentially conducting the orchestra, calling the shots, buy this, sell that on a day-to-day basis. On the ETF side, with the passive management, typically those decisions are going to be made by some sort of computer algorithm. So there's not going to be that guy or gal at the top that is conducting that orchestra. The orchestra is conducted by an algorithm. So that distinction leads to a huge difference in terms of taxability of these two types of investments. So a mutual fund, given that active distinction, has to, by law, has to pass out any income that is generated within that fund to the investors, pro rata. So if there's 100 investors and there's $100 of interest, $100 of dividends, and $100 of capital gain, each one of those 100 investors is going to receive $1 of dividends, interest, and capital gain. The piece that really makes a difference there is that capital gain piece, because that is what at the end of the year you'll receive on your 1099. You'll see a box for capital gain distribution. A mutual fund is going to pass out its pro rata capital gains realized throughout the year to its investors. The rub here is that that is not followed by a check. So if there is a $20,000 capital gain distribution attributed to you as an investor, you're not receiving a $20,000 check from that. That is going to have to be funded by other investments, your pocket, whatever it may be. So you sort of get this phantom income that is reflected in your investment account, by the growth of the mutual fund, but you're not getting the actual dollars and cents to fund that tax bill or that capital gain distribution. Where ETFs become a lot more efficient is that because of that passive distinction, they are not required to pass out those capital gains. There are certain ETFs that will pass those capital gains out depending on the structure of it, but by and large, an ETF is not going to have that capital gain distribution at the end of the year. What does that mean? So you're always going to have to, whether it's a mutual fund or an ETF, you're always going to be declaring and earning income based off of the interest and dividends that are received. It is next to impossible to find a mix of investments that are not going to kick off some level of interest or dividends. It's the way the financial world works now. But by not having to claim that capital gain distribution on a year-to-year basis, it can be a pretty big swing in terms of similar mutual fund versus a similar ETF investment, in terms of come tax time. So if you are in an after-tax situation, if you're in a qualified account, your 401ks, your 403bs, your 457s, et cetera, we don't care about the capital gain distribution. That's just getting added to the pot that will be taxed to you when you start taking distributions somewhere down the line. So this distinction does not make nearly as much of a difference in the qualified world. But in the non-qualified world, in the after-tax, in the brokerage world, unless you are pursuing a very particular strategy, which is typically going to be an income strategy, you're probably going to want to look more towards the ETF side of the equation, simply because you're getting similar performance, you're going after pursuing a similar strategy, and you're paying less because typically an ETF is going to be cheaper in terms of the portfolio costs to the client, but it is also 9 times out of 10 going to be cheaper on the tax side as well.
So Matt, that was a good overview on the differences between mutual funds, ETFs, when it's more beneficial to use one versus other. But tell us a little bit more about tax loss harvesting.
So tax loss harvesting is, it's been around forever to a certain degree, especially with your higher net worth clients. And essentially what tax loss harvesting is no matter how good the market as a whole is doing, how well or how poorly, stocks move in different directions. So 2023 is a great example of this. So the S&P 500 was up, call it 26.5% in 2023. And if you take out the Magnificent Seven out of the S&P 500 in 2023, the total gain across the S&P 493 was somewhere in the neighborhood of 2%. So the market was incredibly, incredibly concentrated, especially in those 7 stocks in 2023. So what that means is you had 7 buoying the market up pretty well. The rest of the market was either flat or down. And that presents an opportunity for an investor to say, okay, I have this group of stocks that is doing incredibly well and they're pushing my portfolio up, but I have 400 other ones that are down or down big for the year. And what tax loss harvesting allows you to do through a partnership that we have with BlackRock, it allows you to essentially invest in the S&P 500, across the board. So there's actually 504 companies in the S&P 500 right now, confusing as that may be. And they invest you across the weight of the S&P 500, exactly how the index is weighted. And you actually own those individual stocks versus owning an index fund, which would not allow you to pursue this strategy. And essentially, at the end of the year, they're going to go through and say, okay, we have a $30,000 loss on this particular stock. We have gains in these stocks. So we're going to hold on to the stocks that have gains, and we're going to sell off the stocks that have a loss. Probably, they look at, level of loss and everything like that. And if we have a good loss that has been generated by this particular stock in this year, we're going to sell that off, put in a closely related stock for 31 days so we don't hit wash sale rules, and then replace it after those 31 days. So your index is still pretty much the same, and you are able to essentially bank those losses over the course of the life of the investment. Now, this is a relatively new strategy. Some people call it direct indexing, but the main goal of direct indexing is going to be this tax loss harvesting idea. And, it is a pretty specialized strategy, it's not for everybody. This is one of the few places where we have a minimum. There is a minimum to be able to get into it. Not all of our clients will be able to or will want to. But some places where this is going to be, very, very helpful is if you own your own business and you're starting to look for an exit strategy. Small businesses, when they sell, there is going to be a pretty large level of capital gain associated with that sale, especially where we see, valuations coming in at these days. So people are getting a huge chunk of money that is largely going to be taxable. So if we have a couple years where we can bank some losses for you, and because these losses, they don't go away. They are with you in perpetuity. They'll roll forward with you in perpetuity. The only caveat to that is if you don't have any gains to offset it in a year, you're going to get dinged $3,000 a year. They're going to take $3,000 per year off of that bank of capital losses that you have. But other than that, you can basically roll them forward as long as you need to. And if we can bank a good amount of losses for you to offset that potential capital gain, it's a great opportunity, to save some tax dollars by, being invested in, the S&P 500 and seeing the overall growth, but being able to take the opportunity to take this particular stock or this particular stock that's down and, bank those losses, to create some tax benefits for it.
Oh, it's definitely a great strategy to save some taxes, over, the years. I know when you're going through that, you mentioned the wash sale rule. Can you just kind of walk through what exactly that means when it comes to tax loss harvesting?
Yeah, so the wash sale rule is basically the biggest impediment to this strategy because essentially what the wash sale rule tells us is if you were to sell a stock and if you were to sell it to, say, lock in losses and you were to buy it back the next day, the IRS looks at that and says, you're manufacturing losses. So what they require you to do is if you sell a stock that you do bank a loss with, you do realize a loss for, you are not allowed to buy back that exact stock for 31 days. After that 31 days, you can go back and buy the same stock and, reinsert it into your portfolio. But really what the IRS is preventing people from doing is seeing a quick downturn in a stock, selling it, and then buying it back at that low point. So then they can, potentially reap the benefits of, selling low. So the IRS is going to make you wait 31 days. So in this tax loss harvesting strategy, in that 31-day period that you have sold and locked in those losses, they're going to find something that is very similar in terms of the type of stock, the type of company, the type of business. Insert that in there, and then at the end of those 31 days, you'll sell off that similar company and go back to what the S&P 500 or another index that you choose dictates that they should do. So one of the big decisions that clients may have if they are sitting on, extra money that they want to contribute to either a traditional or a Roth is, which one to choose. What do you think are some good, insights into which decision to make there?
Yeah, so we've mentioned a lot in, this episode earlier this month. You kind of always hear Roth traditional, Roth traditional. But what that really means is what side of the fence are you paying tax on? So with a traditional, you're paying tax at the withdrawal, but what that means is you get an immediate deduction on your contributions. So typically, if you're a high income earner and you plan to be in a lower tax bracket in retirement, traditional might make more sense for you. And then on the flip side with the Roth, you're paying tax on the other side of the fence. So you are taxed on your contributions, no tax deduction like the traditional. But what you do get here is at the time of withdrawal, when you're in retirement, no tax there. So I think this is good to clarify because a lot of people hear young people should go Roth, old people should go traditional, but it's a bit deeper than that because what it really has to do is your tax bracket higher now or is it lower now versus retirement? So a good way to think about that is high tax bracket now, lower tax bracket in retirement. We want to go with traditional. And then with a lower tax bracket now, higher tax bracket in retirement, we're going to want to think more Roth.
Now, maybe someone has been contributing to their pre-tax retirement accounts through their lifetime. Maybe they haven't really built up their Roth accounts too much. What is the strategy that someone can do if they want to possibly shift some money from their pre-tax retirement accounts to a Roth retirement account?
Yeah, so a relatively newer strategy we're seeing is a Roth conversion. So that's where you take the money in your traditional or pre-tax qualified accounts and convert that over to Roth. But the big thing you want to focus on here is the income tax liability. So we just mentioned with traditional, you get a deduction on your contributions, you pay tax on the way out. Well, when you're switching from traditional to Roth, that is the way out. So you're paying income tax on that entire amount you're converting. So there's definitely a couple of things you want to consider before going into this, right? Roth is newer than traditional. It's kind of the hot new thing. Everyone wants to do it, but you really want to think about, does it make sense for you, especially with this tax bill? So first things first, if you're in lower income years than normal, I think that's definitely a telltale sign. It could be a good year for you to consider converting. So let's say typically you make on average, 200,000, whatever reason, one of your income streams is lower this year, you got 100,000. Since you're used to paying tax on 200,000, you might be available to convert, but also don't think about, maybe a whole lump sum, maybe converting over time, chunk by chunk by chunk, trying to keep that tax bill down as much as we can. A telltale sign a Roth conversion may make sense for you is if you're able to pay the income tax on the conversion from cash instead of taking it from your IRA. Because let's say you have, $1 million account and you want to convert that, but you have to foot the income tax bill from your IRA. You're taking your account down from whatever your marginal tax rate is there, and then you're only investing what's left over. So it does take you some years to kind of break even, get back to the money you had before. So what we really want to think about here is, does it make sense tax-wise? But, if it does make sense for you, if you're in a lower income bracket than normal, and you do go through with converting, it does offer some great benefits, right? Because now your money is after tax, after paying that tax, and you are not paying tax on the way out since you already paid it. If there's also some other things I consider, like you think tax laws may change, they may rise brackets, Roth is a hedge against that tax uncertainty because, again, you're paying the tax now, so you don't have to worry about those tax brackets down the line. And then lastly, also something to consider is RMDs. We mentioned before in prior episodes, traditional does have RMDs, but with Roth, since there's no tax on the way out, there are no RMDs. So this conversion would also offer you the ability to lower RMDs and eliminate them from those accounts you convert.
A lot of people are stuck between this Roth and traditional distinction, but they can be used together, and they can be used in a broader portfolio of various types of accounts. So if you could just walk us through that.
Yeah. So, I think like we just did here, a lot of people compare what are the differences? Traditional, Roth, you have this, and it kind of breaks it up and segments them in a way to where people think, oh, I have to pick Roth or I have to pick traditional. But in reality, like you mentioned, you can do both. And tax-wise, for many people, it's beneficial to have a little bit of both, not just one or the other. So one of the things that I think we see a lot, especially with the Roth and the rise of how popular they're becoming, is some people, younger people, will go all Roth, Roth, Roth. I heard I should just do Roth here. You don't have any taxable income at retirement, right? No traditional. And a good benefit there is, especially if you're in the 22% marginal tax bracket or higher, you actually will receive some tax optimization by having a little bit of traditional income. So what I mean by that is you want to utilize a traditional IRA up until those 10 to 12% brackets, because like you mentioned earlier, you're getting a tax deduction and paying tax on the way out. With the Roth, you're not paying tax on the way out, so that's not taxable income. And what I mean by using the traditional is if you have all Roth, but you put a little bit of traditional there, you're only paying up to that 10 to 12% bracket there, which gives you more of a tax benefit than going pure Roth and say you're, like you mentioned, 22% marginal tax bracket or above, you're paying 22% versus traditional, only 10 or 12% on the way out. And then kind of tie all that in, I like to call it, the tax triangle is you also, I think, want to have a brokerage account or, not some sort of qualified investment account with these restrictions. Because like we mentioned, traditional and Roth, they offer you some great benefits, traditional deduction, Roth, tax-free withdrawals. But with those benefits comes restrictions, right? The IRS says you can't withdraw unless you're this age, or you could, but for this reason. Or if you do, you have early withdrawal penalties, right? So many little things to think about there. So you want that third taxable account, the brokerage account or after-tax account like we mentioned earlier, because while it doesn't have those same tax benefits as traditional Roth, It still has some with, the long-term capital gains and some qualified dividends, but you still pay taxes on, both sides of the fence potentially. But the reason you want that is without the benefits, without the restrictions. So you have the flexibility. If something comes up, you need this cash, you don't have to worry about, does this qualify withdrawal, or am I have to pay the withdrawal penalty out of my traditional or out of my Roth? So good thing to think about there is kind of don't segment Roth traditional, one or the other. Kind of think of it holistically. How can I use both of these? How can I use a brokerage account to create that, tax optimization triangle?
Yeah, it's wise to, diversify your investments, right? Which is what we do for our clients, every day. But you also want to diversify your taxable, accounts and your retirement accounts, and have some tax diversification by having money in kind of, like what you said, Hayden, each one of those three buckets, right? Versus maybe having, all of your money in a pre-tax retirement account. That's not really going to give you a ton of options, both in retirement and while you're working, because you have that flexibility with the after-tax accounts to use the money before you're 59 and a half, or, whatever you'd like. So, I think that's really important too, to have that diversification, not just in your investments, but, in your overall sort of net worth, and with all of your different investment accounts as well.
So Hayden, Matt, thanks a lot for being here for the 4th episode of the Plan, Protect, Invest podcast. We went over a lot today in terms of, how to make your 2025 filing a little bit smoother. But one thing we really want to, reiterate to our clients and potential clients out there is that where we can help with the investment side, and, we're certainly one to come to how to invest and where to invest. There is also thought put behind the investments, and, making sure that we're saving as much taxes as possible, and, whether it's in that particular year or moving forward. So I think if, obviously, if there are any investment questions, give us a call. But if there are any tax questions revolving around your investments, we are definitely the place to go. So give us a call at 716-674-6700, or visit us online at www.scroylolly.com. And let's have you in for a review.